Breaking news story, credit report costs are going to the moon in 2024. That's right. This is a breaking news story in the mortgage industry, and I thought it was important to cover it with you guys because it affects you. It affects you, the buyer, and there's some serious impact that this could have over the next year. So I want to make sure that you guys understand what's going on, why it's going on, how this has happened, and why everybody needs to raise their voice, because otherwise you are going to be paying a lot more. Okay, so what's going on? 2023, the credit bureaus and FICO decided that they wanted a raise, a big raise. And the way that they did it is they did tiered pricing. So based on how big a mortgage company was, they would set the pricing. And people said, wow, this is outrageous. And they said, okay, great. We're going to make everybody the same and we want another raise. So basically a report that a couple years ago was $20 is going to be $50 to $60 next year. Yeah, that's how much a credit report's going to cost. So first of all, let's talk about how this is happening, how this is a thing, and then how it will impact you. So this will be a longer video. We're going to be talking basically about the credit history, the history of credit in the mortgage industry. Okay, so first of all, how could companies just give themselves these big of raises and get away with it, right? Because it's like if Walmart decided to increase their prices by 500%, well, Target would be there to be like, we got you, we're not doing that. There would be some level of competition. The issue in the credit reporting space in mortgages is there's no competition. None. Right now, the only recognized and used scoring system, this is important, guys, that is recognized by Fannie, Freddie, and Ginnie, which is the bulk of mortgages in America, is FICO. That's it. And people go, well, wait, Jen, Vantage. FHFA said that they were going to recognize Vantage. It hasn't rolled out yet, guys. Like, if you look it up, I looked it up this morning because I was like, I know they approved this a couple of years ago. Why is this taking so long? It's in like public comments right now, okay? And here's the thing about Vantage. So Vantage was created to be an alternative to FICO, right? So the theory is, look, you get, there's another competitor. You got your Walmart versus Target. Okay, but here's the funny thing about Vantage. Vantage is owned by the credit bureaus, Experian, Equifax, and TransUnion. So the argument against Vantage is that since they own it, they're going to give Vantage preferential treatment and they'll push out FICO and then you'll end up in the same position. That's the argument against it right now. And I think that's probably why we haven't seen it implemented with Fannie, Freddie, or Ginnie loans. Home equity lines are a different story, but the main loans that people come to, we're going to be using a FICO score. So FICO has a captive audience. Now, what's interesting about FICO, because you're like, well, wow, if they've had a captive audience for how long? Decades, guys. Like since the 90s, it's been FICO. And you're like, well, why is it so crazy now? Fun fact, I did a little digging. We know I like to dig. And up until 2018, the credit bureaus did not allow FICO to increase their fees. In 2018, FICO renegotiated with the credit bureaus, Experian, Equifax, and TransUnion, so that they could raise their fees. Now, what I have been told and what I have found, and we'll talk about why this is so hard to find, in 2021, each time, let's say I do a credit report for one person, I'm gonna pull 3 bureaus. FICO's charge would be about 50 cents a bureau. Okay, I spoke with a credit person last night. This is a guy, all he does is sell credit for a living. He told me the new FICO charge is $8 per bureau per pull. Yeah, so we're talking about what was $1.50 in 2021 going up to $24 in 2024, excuse me. Oh my goodness, $1.50 to $24 in a couple years. It's nuts, it's nuts. Okay, so how has this happened? They have no competition. They have no one to stop them. They have no one that's saying you can't do this, period. Okay, so who pays for this? Well, you guys do. Now, here's what's interesting about the whole thing. It's really hard to find the exact increases of what's going on because the way that it works is FICO says, hey, we're raising our prices to Experian, Equifax, and TransUnion. TransUnion, all the bureaus then say, that's a good idea. We're going to raise our prices as well. And then they go to the companies that actually put all this together and sell it to mortgage companies. And those people, you know, depending on which company you talk to, they're saying, oh, the credit bureaus and FICO raised it, but they're also padding it for them. So you've got number one, and then number two is like, I want to raise, and number three is like, I want to raise. There's no transparency. The lack of transparency is staggering. Like, I was like, can someone just get me a chart that shows what did FICO charge in 2021? What did they charge in 2022? What did they charge in 2023? What are they charging in 2024? I couldn't find anyone that could get that to me. Same with the bureaus, Equifax, Experian, and TransUnion. I couldn't find anyone that could get that to me. Now, if someone's watching this that's like, I can get it, send it over. Like, look, there are so many consumer groups, watchdogs, like the industry is not okay with this. So if you guys are like, oh, the mortgage lenders really don't care. No. We are all at a loss, furious, because it's making the cost to buy even more expensive when housing's already very expensive, rates are high, the cost of doing a loan as a mortgage lender is expensive, and all these companies have decided that they deserve a raise during, some would argue, the toughest housing market in the last 27 years. But there's no way to stop them. That's the thing. So if the only scoring model that's recognized by mortgage companies because of Fannie, Freddie, and Ginnie is FICO, there's no option, guys. There's no option. And then if you go, well, when Vantage, great, you've got Experian, Equifax, and TransUnion that are going to be controlling that as well. So where is the free market in this? That is really the million-dollar question. Now, just to make things even more fun, so you guys may have heard of trigger leads. So when a lender does a hard credit pull, what happens is the credit bureaus sell your information to other lenders. Now, if this has happened to you, drop it in the comments. Have you had 75 lenders call you who you never inquired with? Yeah, that's because the credit bureaus sell your information. We don't give them permission. We can't pay extra to stop them. We have no power. The Mortgage Bankers Association's been trying to stop this for years. There's been multiple bills that have been tried to pass to stop trigger leads to protect you guys, but they all die. They're all DOA. So why are they all DOA? Well, because the credit bureaus go, we're encouraging, shopping, we're encouraging competition. Isn't it funny how they encourage competition when it financially benefits them? So then, right, we've got all this education going out about your credit scores. People are super focused on credit. A large of this is because of marketing by Experian, TransUnion, and Equifax, right? Monitor your credit, watch your score, all of this. So they create soft pull. A soft pull at first was like really cheap for a lender, really cheap. And it would give a lender an idea of where you were at without having to do a hard pull. There were two main benefits to it. Number one, it was really cheap, okay? Number two, it let the consumer, you, have an idea of where your credit score was without it being a hard hit on your credit. And number three, it stopped the trigger leads, okay? Now look, you cannot close a loan with a soft pull. It's impossible. But if you were thinking of shopping, if you're new to the process, a soft pull can be a great way to get your foot in the door. And as a lender, we were like, okay, we don't want you being tortured by other lenders if you don't want. If you just want to see where your score is, if you're not quite ready, a soft pull can be great. It doesn't cost us as much money. Fantastic. Okay. About that, so soft pulls now are going to be the same cost as a hard credit pull. So you're going to see lenders start charging you guys if you want to do a soft pull for the soft pull, and if you want to do a hard pull for the hard pull. And if you're like, oh, well, the lender's not charging me, it's going to be in the fees. It's that simple. It's like, look, our fees are going up $200 next year. VA, we still waive our fees, but everything else it's going up $200, and that's because we have an increase in fees. And it's not just the credit reports that have gone up. everything that's electronic on loans, verification of employment, Social Security verification, everything that's been designed over the last few years to make loans easier and faster for you, the providers of those services are giving themselves a raise. Where does it end? Where does it end? So here's what you guys need to know. Is it likely that next year you will see lenders charging for credit up front? Yes. Yeah, it's really likely. And the reason is they can't afford to stay in business if they keep on just saying, yeah, like we'll let you pull your credit. If you don't go with us, no worries. It's just not economically feasible. You know, I was talking to someone who was telling me that the pull-through rate for mortgage companies from application to close is like 20%. They can't afford to just eat these incredibly high credit costs on 80% of their applications. They'll be out of business, right? So I do think you're gonna start seeing lenders charge for credit. At this point, you know, I work at Guaranteed Rate. We're still trying to figure out what to do. You know, we're trying to figure out how do we do what's right for the consumer, but how do we also make sure that this doesn't bleed out the company, right? Because that's what lenders have to think about. You know, Guaranteed Rate's a really big company, so I'm confident, you know, we're gonna have a solution, and they're proactive. But there's a lot of companies that don't even know this is happening. That's the messed up part about this as well. The companies that sell credit to mortgage companies, I was told that they weren't even notified of these dramatic increases until October. And most of them did not start telling their clients till the end of November, beginning of December. Yeah, guys, I was on the phone with other lenders, like, because as soon as I found out, I was like, we gotta stop this. You know, so I called all the influential people I knew. Some of them didn't know. Their credit people hadn't told them yet. Right, so the whole industry is reacting now. So what can you guys do? Because you're like, use your voice. Use your voice. If you guys don't follow me on LinkedIn, follow me on LinkedIn. I am gonna be spouting off about this. I spouted off about this today. You know, National Mortgage News, Housing Wire's covering this. We need Wall Street Journal to pick up this story. We need the CFPB to go, oh, wait a second, this will affect people. We need voices. Because if you're like, well, Jen, I'm gonna have to pay for a credit report, big deal. Guys, it's gonna discourage rate shopping. Right? Because let's say you're talking to 3 lenders and all 3 lenders want to get you pre-approved. They have to pull credit. Can you afford $150 just on credit reports? Is that the best use of your money? Because the stupidest part about all of this is that if you run your credit with me, there's not like a code that you can use so that the other lender can use that to underwrite your file. Okay? Right now, every lender has to pull their own report in order to run it through desktop underwriting or LP. Seriously. So it's going to be expensive. And then my fear as well is, look, sometimes you apply with a lender and let's say you're paying for the credit report and they deny you. You may not try with another lender because you've already been denied. You've already lost $50 or $100, whatever it is. So it's discouraging you. That is where I see that this could have a huge negative impact on the industry, because as a lender that does those second opinions every single day, I can tell you there are a lot of lenders declining loans that should not be declined. However, I can't tell you a loan is going to work without running it through desktop underwriting. And I can't do that without doing a hard credit pull. Yeah. And sometimes people go, well, you can do it with a soft pull, not with DU. And guess what? The other thing that we found out with soft pulls is that if you run a soft pull through LP, which is another underwriting system, you can get a decline. Whereas if you do a hard pull and then you run it through DU, you get an approve. So the whole thing is a mess. And it's time to raise your voice. So I did this video so you guys know what's going on. Look, I can only scream so loud. I need some help. So please reach out to your legislators, reach out to the CFPB. I'll have some links of who to reach out on. Follow me on LinkedIn. Even if you just share my post to your network, it helps. Every single voice helps. And this is nonsense. Consumers cannot afford this, and it's not okay. So questions, comments, guys, feel free to reach out. but I think you can probably tell I'm pretty passionate and outraged. So I definitely want to amplify this issue, and hopefully, you know what, maybe with enough voices, we can get them to dial it back, or we can get some legislation so that the increases stop. Because what if they go up again in 2025? Another 100, 200% increase? Nah, that's not good. Thanks for watching, guys.